Dallas Cowboys. Nice. My brother, my mom, actually my whole mom's side of the family is like freaking diehard Dallas Cowboys fans. One, two, three, four, 5, 6, 7, 8, 9, 10, 11, 12. Cowboys, can you mute your mic? I don't even know if you can hear me.
Hey Derek, when you present, will you go full screen automatically, or like do we have to do something to make your tile bigger?
I think if you just click on my tile, it should make it bigger on your screen.
At the bottom right. The bottom right of.
Do I make mine full screen? Is that what you're asking?
Well, I'm trying to make you full screen, and yeah, I'm not seeing a way to do that.
If you click on my tile, what happens?
Yeah. When I click on your tile, yeah, then the pop up with camera. What is it? It goes away. Camera, share, microphone, the rocket, and then get off the call button.
Let's see.
Okay, and then I push that up, and yeah, I'm not seeing that.
Oh, how about at the top of your screen? Here, let me share my screen. Hold on.
Look at the chat.
General screen 1, go live. Okay,
Yeah,
can you see my screen here?
No.
Yeah, there's another tab that pops up. You click on it.
Yeah, I'm sharing my screen. You should be able to click on my tile. It says Derek N, and it's got a little computer monitor next to it. Oh,
Okay. Oh, I see now.
oh, you're on your phone. You should still be able to make it full screen.
I'm on iPad. Yeah.
You're on your iPad? Okay. I don't know if it looks the same. Are you looking at my screen?
Yeah, now I am. Yeah.
Okay. Were you able to make it bigger or no?
Okay. Yeah, it is. Your screen. I'm just seeing your screen now.
Okay.
All the tiles and yeah.
All right. Because I think, at least on the desktop, you can go to the top where it says focus and hit that. And then I think it collapses all the tiles into smaller tiles, and then you can select individual people at the bottom here.
Good deal. Thanks.
And then if you click it again, it says grid, and then that shows you all the tiles. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Oh, it says right there. Okay, 13. All right, well, I guess we can pretty much get started. Everybody hear me okay, though?
Sound good.
Sweet. Just a suggestion, but is it possible to record the call for people missing it? And yeah, loud and clear. All right, good. Yeah, I am recording the call. I'm recording on OBS. So hopefully we're good. All right, let's see. So I did put a question out there for what topics people would like discussed, and the responses pretty much was diversification of symphonies, overfitting, specific symphony critique, open forum I put on there because I think it's always good to just kind of have an open forum and people can talk about whatever they want to talk about. And then on the last call, it was mostly about position sizing or like risk per symphony. So I'm going to touch on that again since I'm recording this call. So people that missed the last call, they can go back and watch this one, and I'll touch on it again. So let's see here. Actually, I'll go to my watch list. All right. So let's see. I guess I'll touch on position sizing first. That way, if people that missed and want to see it, they don't have to fast forward through the call to get to it. They can kind of see it first, and then they can go from there. So when I talk about position sizing, it's just how much money you should, and this is all going to be in the context of using Composer. So I'm not really going to focus on trading in terms of position sizing when you're trading manually, but obviously this is a Composer focused community, so that's mainly what I focus on. So when I'm talking about position sizing, I'm talking about in terms of money that you're going to allocate towards a certain symphony, and then that will also trickle down into your diversification of symphonies. So the better your position sizing, the more diverse your symphonies can be, and the more symphonies you can be invested in. So it really will help you out in terms of the volatility of your symphonies and sort of the daily volatility that you're seeing on the daily trading. So, because I know a lot of people in here, they're seeing 3 or 4 or 5% drops in a day, or gains in a day, either way. But most people can't handle that, especially if it's 2 or 3 days in a row where they're seeing 1 or 2+% moves. And a lot of times that can go on for 1, 2, 3 months, where you're seeing a 40 or 50% drawdown on your account. So I'm gonna go through all that so that if you're looking for sort of a more stable portfolio that slowly makes money, that's kind of what I'm after. So that's what I'm gonna talk about. So let's see. I did make sort of I guess like a mock portfolio, and it's sized according to the risk of each symphony that's in it, and it's diversified, so it's kind of invested in a lot of different symphonies. So I'm going to kind of go over that. But this is the mock portfolio. I just named it diversified portfolio. The reason why it says equal A, I'll get into in a second, but it just helps me know which symphonies are invested in the portfolio, and they're all labeled in my drafts folder so that I know which ones are in it. So this is kind of what it looks like. So the weightings are specified. So you can see here, 20.6% is invested in these specific symphonies, and then 6.72% in emerging markets, 12.18% in negatively correlated. And they're not necessarily negatively correlated. They're just more so a little bit inverse the market, and then also a very low beta to the S&P 500. So I just named negatively correlated. It's just easier to identify. And then energy, 11.1%, and then more conservative symphonies, 20.6%. And then the rest of it that's left over is just simply in short-term treasuries. This really decreases the volatility of the overall portfolio. So I think it's good to have a nice chunk of it in short-term treasuries. So, and I'll go over, again, this is position sizing that I'm talking about. So I'm going to go over how I get these percentages in these individual groups. So does anybody have any questions before I get going here? Let me check the chat real quick. Okay, we're good there. All right, so if nobody has any questions, I'm going to kind of go into each of these branches. Again, this is just a mock portfolio to kind of show you how I divide up the investments into each sort of group. So I'm gonna go look at the back test real quick. So it doesn't go back very far just because a lot of these symphonies, mostly these ones up here, they contain tickers that just are not testable very far back, which is fine. I mean, if I think if your portfolio is divided up in such a way to where you have your risk sort of spread out like this is, you don't necessarily need to worry about testing too far back. You can kind of modify it as you go, because as you can see just from this is a back test just for 2023. This symphony is a lot less volatile than the buy and hold S&P 500. So you're not likely to experience higher drawdowns than what the S&P 500 is experiencing. So, and that kind of bears out right here. If you look at the max drawdown, this is since January of this year. It only has a max drawdown of about 2%, versus the S&P is about 10%. Where you can tell if it's going to be volatile or not is if you look at the standard deviation of the symphony. This will tell you sort of what the volatility is to be expected. So if the standard deviation is actually lower than the S&P, it's probably going to be a lot less volatile. It's actually more than 50% less volatility. So let me go into each branch and sort of go over how I get these weightings and why I do that. So in the leveraged aggressive, let me open another, let me go to my drafts. So each of these, I have each of these groups saved as their own individual symphonies, so it'll be a lot easier to go over. And that's why I have, so you can see these individual symphonies, they're marked with the letter A. It's just so I know which master symphony that they belong to, which is why this one says equal A. So that's kind of how I identified them, so I know which individual symphonies belong to what master symphony. So the first one, I'll just go over the conservative portion. So again, these are just more conservative, much less volatile symphonies. So if I run a test on these, you can see the max drawdown is pretty low, and this is since 2016. So I think this can actually go much further back. I'll just try 07. They might go back that far. Let's see. Oh no, it only goes to 2011. Okay, so since 2011, this one has a 24% annualized return and a 13.4% max drawdown. So I do consider that pretty conservative, especially because the Sharpe ratio is 2.0. So for those that don't know, your Sharpe ratio is basically the returns that you're getting versus how much risk is involved in the portfolio. If I'm wrong on that, somebody please correct me, but I'm pretty sure that's how I understand it. So let's see. It's got Copy Ray Dalio, which is basically like a community symphony that composer published. So I just took that and sort of modified it on my own, but basically it just has equities, TLT momentum, IEF momentum. So this is 20-year treasuries. This is 10-year treasuries. DBC is a commodities ETF, and then GLD is a gold ETF. So that's the copy Ray Dalio version that I modified. And then the other two is, a lot of it is just bonds. So it just converts, excuse me, it compares bond performance versus SH, which would be an inverse S&P 500 ETF. So it looks at 20-day bond, 30-day IEI, which is another, I think that's a 3 to 7 year bond, if I'm not mistaken. And then bond baller. Again, these are just, like I said, there's not much to these. They're very simple. This one just has QQQ, XLP, which is consumer staples, and technology ETF, and then a S&P 500 short inverse ETF. So that's those three. And then this one, Berry Bonds, I made this one a while back. Same thing. It sort of just compares the performance of bonds versus the performance of the equities market. So I'm not going to go in depth and explain how it works. We can do that another time. But these are conservative performing symphonies. So I bunched them all together. So what I do is if I'm going to add this to a master, so like how you can see in here, let me collapse all these so it'll be easier to track. Okay, so I have 20.6% allocated to the conservative portion. And the way that I come up with that number is my rule is basically, let me jot it down here. So the rule that I like to follow is never risk more than 1%, oops, of your equity on any one trade. So this is kind of the rule that I follow for my account. And the way that I do this, think of a trade as a symphony. That's kind of how I look at it. So basically, I don't want to risk any more than 1% on one symphony on any one particular day. So you could swap the word trade for symphony because we're talking about composer. So, and I guess to add on to that would be on any one day. So if I'm going to invest in this symphony, I don't want this symphony to lose more than 1% of my portfolio's value on any given day. So the way that I do that is I'll go here, I'll copy the link for it, and then I go to the quant stats, and I put in the Symphony URL, and then I look at a report. And then so I'll download the HTML because it's just easier to view that way. So I'll bring up the report, and then I go straight to the worst one-day performance for the Symphony. So this one is negative 4.85%. So I look at the worst day because I'm trying to define what my risk is going to be for this Symphony. So since 2011, if this Symphony had its worst day of minus 4.85%, I only want to risk, let's say if this Symphony has another negative 4.85% day, I only want that to result in a 1% loss on my total account. So the way that I do that is I use this percentage calculator, and this is calculator.net. So up at the top here, just click on percentage calculator on the home page. So if you go home, math, percentage calculator, this is how you get here. So first you'll want to figure out what 1% of your account is. My account's about $5,000. So 1% of my account is $50. So I only want to risk or lose a total of $50 on any one day on this one specific grouping for this Symphony. So what I do is I take $50 and I'll do 50 is 4.85% of what? Because 4.85% is the worst day for that symphony. And then it'll give me a number, so 1,030. And since Composer works on percent allocations, I'll take 1,030 and I'll put it here. And I'll say 1,030 is what percent of 5,000, 5,000 being my total account, my total portfolio equity. And then I'll calculate that and it'll give me a percentage, which gives me 20.6%. So then I'll add that to my master and then I'll allocate 20.6% to that specific symphony. And that's how I come up with these numbers. So by doing that, you're defining your risk. So you're knowing what you're doing is basically saying, okay, if this is my entire Composer account, and this is why I use a master symphony like this, because I'm defining my risk for each individual symphony that I'm running. You don't have to do it this way. This is just how I like to do it, so that I can track the performance too, like here, because I don't want to just track the backtest performance. I want to also track the live performance. So if I go to my portfolio, if I go to, so this is my master. It's just called Interstellar, but it's my master symphony. So if I open the fact sheet for it, it's going to give me the live. It's going to give me the live results for my master. So let's see, I've been running this since October 27th. I really wish they didn't, this is like a data error, and I wish they would fix that because that's kind of annoying to look at. So this is sort of the equity curve on my live account. This down day here, that was that failed trading day. So I'm not sure what that would have looked like if the trades executed the way they were supposed to. But my account didn't trade at all that day, so it kept the previous day's holdings.
How's it going? Good.
So
Yeah.
okay, whose mic is on? Oh, Narwhal. Hey, Narwhal, can you mute your mic for me, please?
Yeah. Well, want to play? No. Play.
Here, actually, I think I should be able to mute him, right? Oh, yeah, there it is.
Yeah, over there. All right.
How do I mute individual people?
If you right click on that, you can
Oh, gotcha. Thank you. All right, cool. Thanks. Okay, so anyway, I want to be able to see what the like the Sharpe ratio, the max drawdown for my live account, stuff like that. Obviously, you could, if you're not using a master, you could calculate all that stuff. I want to just click on it and see it and be done with it. So since I started it, which was October 27th, my max drawdown so far has been 1.4%, which I believe is somewhere right here. And then my Sharpe ratio currently is 4.37, and that's kind of really all I care about. This annualized return is going to change all the time, so I'm not too worried about that. But anyway, that's why I use a master symphony, because I want to see my equity curve, and then I want to see sort of the stats on it. So in terms of position sizing, that's pretty much how I calculate that stuff. So what is going on here? Okay. So yeah. So, and like I said, 1% is just my rule. You could do 0.5%. You could risk 2%, 3%, whatever. But that's how I get those numbers in terms of allocating to a specific symphony. So let's kind of put it into perspective too. Who has a good example of a super risky symphony that's maybe high return but also super high risk? Anybody think of one off the top of their head? I know people keep mentioning Wham or Wooden Arc Machine. I think you can do the math this way. 100 divided by the max drawdown percent of the Symphony equals the percent of portfolio. So 100 divided by 5 equals 20. Nice. TQ for the long term? Okay, we can I'll focus on that one. All right, so let me go to my drafts. I have a long backtest version of TQQQ for the long term, so I will use that one because obviously it'll give me more data. So let's see. All right, so let's just go down here. I'm going to run this real quick. And then I think it goes to about somewhere around end of 2011, so I'll just click 2010. Okay. Yeah, October 2011. So let's copy this and we'll go here, put in the URL, get the data for this one. So yeah, this is an example of a high risk, high reward Symphony. So since 2011, this one has an annualized return of about 210% with a max drawdown of about 49.6. So super high risk. Okay. So if I go to the worst day, this one is 22.5. So if I want to risk 1% of my account, I'll do 50 is 22.5% of what? 222. So I'll go 222 is what percent of 5,000? That gives me 4.44. So 4.44% of my equity of my portfolio would be allocated to TQQQ for the long term. So that's what would be allocated to that inside of a master. Let me do something here. So if I was to use that and nothing else, come on, man, go. Let's just say I wanted to do this and then literally the rest cash or whatever. That's what your stats would look like. So it'd be super, super conservative and super, super low drawdown. Yeah, or if you wanted to risk 2%, you would just go 8.88 and then the rest in cash or other symphonies or whatever. And then you could do it that way. So this is a good way to sort of give you a bird's eye view of how much, how do I say it? Like, I mean, how much risk you could take on your account. Like, you know, that's 2%, or you could do 3% or whatever. So basically you could take that original 1% number and just double it, and then and keep going and just keep stacking on it from there, and just make it, oh man, I am freaking horrible at math. So what would be the next 8.88 plus 4.44? And you could just keep adding 4.44 to get your, if you want to take like a little more risk to get a higher return, but then a lower, keep the drawdown somewhat lower, you could do that too. What was it? Doesn't matter. I already deleted it. So yeah, okay, so that's how I do the position sizing. Any questions on that? Any advantage to running symphonies separate instead of a master and rebalancing, say, quarterly, able to eliminate risky synths if signals return? Yeah, absolutely. Have you looked into using the Kelly criterion bet size for QuantStat? Yeah, I do. I have looked at Kelly criterion. The problem is it always gives you this sort of this super low number. Let me go to that conservative one. So I have this conservative one, which is it gave me about 20%. So if you look at the Kelly criterion, it's 17.21%. So pretty close. But yeah, I mean, you could go off of that too. I don't know I don't know enough about Kelly criterion other than I know that that's sort of the like suggested portfolio size that you could allocate to that if I'm not mistaken. And then I want to answer Seth's question more in depth. Any advantage to running symphonies? Yes. So I think the advantage to running the symphonies separately as opposed to in a master where they're resetting basically every day is, let's say, let's see. Well, if you ran them separately, the ones that are performing better are going to keep growing, and your allocations won't change. And the ones that are performing poorly, you won't keep re-adding to them every day if they continue to decline. So I would say that's probably one benefit. And then, like you're saying, you could rebalance them quarterly, monthly, yearly, however you want to do it. And then you're basically just doing manual rebalancing. I would probably do it that way. The way the reason why I do the master is because I want to see my stats, and I just want to see them easily and quickly. I don't want to have to sit there and do a bunch of calculations. I have two young kids. They take up all my time, so it's I can't really just be sitting at my computer and doing a bunch of math like that. And the other thing is I work full time, and I'm not in front of a computer all day. I work on machines and stuff, so it's not something that I have a lot of free time to do. Otherwise, I would probably do it that way. So the reason I do the master is honestly is just because it's more convenient for me. But I think as I get more time, I'll definitely I'll think about doing it that way. But let's see, let's move on. Love how smooth this keeps the equity curve. Yeah, and that's kind of the point. The point is to have a smoother equity curve, a less volatile portfolio is the whole reason why I say I think it's important to define your risk before you even start putting money toward the symphony. Another reason when we had the data issue, only I had one symphony didn't run. Yeah,
Yeah, sorry, I kind of missed a little bit of that, but yeah, like, I think if you have that during time of potentially right?
yeah, for sure. And just this is just my own personal take, but the way I view Composer is because it's so new. You know, it's a startup. I just assume that those kinds of things are going to happen from time to time, and I just accept it and I just move on. I know it is kind of upsetting when they have those types of failures and stuff, but I mean, for me personally, like I said, it's just my own personal opinion. I just assume that it comes with the territory, and I just cut my losses and move on. But at the same time, like I said, that's why it is important to define your risk. You know, I wouldn't just throw a whole bunch of money into a symphony without knowing how much risk is involved with that symphony. So, I mean, there's other things I like to look at. You know, I like to look at the profit factor. So the profit factor is for every $1 you risk, you make $1.48 with that symphony. And then the other thing, if you like a smooth equity curve, is the Serenity Index. So if you look at the Serenity Index, this is the, I guess, the amount of volatility and risk involved as opposed to, I guess, the return. I I'm not really sure how to word it, to be honest. But if you look at the Serenity of the conservative one versus S&P, you can see that they're way different. The Serenity on the conservative one is much higher than the S&P. This is just buy and hold S&P, and the Serenity is basically 2. So if you take well, actually, I'll just do my discard changes. I have, why did I do that? Hold on a second, sorry. Let me just do my, I'm going to do my master. I think I was around like 60 or something like that. I can't remember. But basically, the higher your Serenity index, the less volatile your Symphony is going to be. All right, so if I copy this, the other thing that's going to help too is you'll recover from drawdowns faster if you're predefining your risk with the Symphonies. Your drawdown recoveries will be much quicker. And yeah, so the Serenity index on my master is a 65.3, so it's really high. And then if you look at the profit factor is 3.05. So for every $1 I risk, I make about $3.05. So I don't focus too much on this stuff, expected daily, expected monthly, all that stuff, because this is only about a little less than a year worth of data. So another thing that will help you too is if you look at the daily value at risk. So the daily value at risk is pretty much on any one day. This is what you could easily see, is how I understand it. Let's see what else. Volatility, you can look at the volatility of it. Mine is just a little more volatile than S&P, which is pretty good for what kind of returns you're getting on that one. And then the Sharpe ratio is obviously your return versus how much risk is involved. So it's at 6.33. Since I've been running it since October 27th, it's on the live performance, it's around 4.7 or something like that. I think I saw earlier. So the Sharpe ratio will help a lot. And then I don't really look at the compounded annual growth rate too much, to be honest. And this is, I think as I have it right now, I have it set to a 2% risk, I think, instead of a 1% risk, just because I only have $5,000 in it. So as I put more money in it, I'm going to reduce the risk taken on on each Symphony. So I think right now it's set at like around a 2% daily risk. Best day 4%, worst day a negative 2.7. The other thing, the other stuff that'll help a lot too is your win days. So that basically, if you have a higher win rate, like 55% is still a good win rate. The problem is with S&P, you could have the losses could be bigger than the wins a lot of times, and so even if you have a win rate that's above 50%, you could have a win rate that's 80 or 90%. But if your losses are larger than your wins, you could still have a trading strategy that underperforms. So especially with the closer it gets to 50%, so if S&P is 55% and the losses are larger than the wins, or they're almost equal, you can have a very flat performing, or you can have periods where your drawdowns could go for a year, 2 years, especially if it's a recession or something like that. So the higher the win rate and if the wins are larger than the losses, you will have a steadily rising equity curve that will be very low in volatility. I think if I go and look at the volatility of Yeah, see, right now the volatility of my master is higher than the S&P. But if I reduce the weightings to 1% risk instead of 2%, this volatility would come down a lot. It would probably, it might even be less than the S&P. So that's another thing to look at. And then you can look at other things, but that's just to keep it focused on the position sizing. A lot of these stats are a result of proper position sizing, because you could be oversized in symphonies and undersized in others, and that could make your account be way more volatile as well. So, if I put, let's just say I did 60% in the aggressive ones on here, and then I reduced, actually I could just get rid of this altogether. And then, let's see. So if I overweighted in the risky ones and I underweighted in the more conservative, for example, I'll probably have a higher return, but the risk is going to skyrocket, and you might even see a decline in the Sharpe ratio too. So 6.03, 3.4, so still pretty good. But these ones are, like I said, I've kind of picked these ones in particular because they are pretty good, and the risk is not too crazy on them. This one's very risky. What more do you need? That one is super risky. And wham and slut stuff, that stuff is just, it's crazy risky. But yeah, so didn't really change it too much, which is kind of nice. What was that? What was it before? 1.9. So the max drawdown only went up to 3 something. Gosh, my computer's going so slow. Probably because I'm recording the call. Yeah, 3.4. So, but better Sharpe ratio, so that's kind of nice. But again, that's very limited data too. So, go back here. Oh, you know what? I can just move right on to diversification of symphonies. So, here, let me check the chat real quick. Paper that introduced the Serenity ratio and explains the formula. Okay, cool, sweet. Follow-up paper from the same group that discusses limitations of the Serenity ratio and how to use it to design portfolios that minimize drawdowns, as well as discussing the minimization of autocorrelation via the Smart Sharpe. They don't bring up the Smart Sortino for some reason, as a better predictive measurement than Serenity for determining allocations, such that a portfolio is more likely to end up having a higher Serenity score. Awesome. Thank you for that, Proteus. Appreciate that. I'm probably going to read those, to be honest, because I do like reading stuff like that. It's very interesting to me. It'd be interesting to compare your portfolio outcomes, risk and return, using Kelly criteria, bet sizing versus basing it on a maximum drawdown. Yeah, although mine's not based on a max drawdown, it's based on a worst one-day performance. But obviously that's limited too, because it's not likely that worst one-day performance is going to happen steadily or predictably all the time. They might never experience that same one-day performance again. Who knows? But I'm just playing worst-case scenario, so that's why I do that. Kelly criterion helps determine the optimal amount to bet on a trade to maximize long-term growth. It considers the trader's edge, the odds, and balances risk. The suggested bet size is a fraction of total capital, preventing excessive risk and promoting sustainable portfolio growth. To be even more conservative, some traders will go with half of the Kelly. I think that's pretty smart. Yeah. And maybe I'll look more into that, because like I said, I didn't really know much about Kelly criterion, other than it helps you decide how much capital to allocate towards a. Well, I guess this might be on specific trades, but for me, I always try to think of it in terms of on a individual symphony. But yeah, this stuff is super interesting. I'll probably spend some time going through all this stuff, because I really like breaking down risk versus reward, win rates, all that kind of stuff. And if you guys want to learn more about that stuff too, there's a really, really good video. I posted it last time, but I'll post it again. What is the guy's name? Tom Basso. There's a really good video of him talking to this guy, Trader Lion, risk management. So this video is really, really good if you guys want to get more education on this kind of stuff, or if you want a different perspective of how to view your portfolio. This would be a really good video to watch. I'll link it in the chat. But yeah, this guy Tom Basso, he was featured in the second book, Market Wizards, by oh geez, what's the guy's name? The author's name? No, I can't remember his name.
Jack Schwager.
Jack Schwager, thank you. He's in the second Jack Schwager Market Wizards book. Highly recommend this video. It will help you think about your portfolio in a different way in terms of risk, and versus how much money you really want to put towards a super risky symphony and stuff like that. So, but yeah, diversification of symphonies. So this is kind of why I made. Let me close this one. Hopefully that'll help a little bit. But this is kind of why I made this portfolio. So it's got kind of a mix of everything. So again, these are the aggressive sort of leveraged, these have 3x leveraged. Pretty much all of these are going to show like hundreds of % annual returns, which that's going to be changing as these symphonies get older and older. Like if you just take one, a lot of these you can only test them back maybe 6 months or a year, and you just don't have a lot of data on them. So over 1 year, they might show, 4, 5, 600% returns. That's just not going to be, it's not going to stay that way. For example, actually, this would be a good example because TQQQ for the long term, this one has newer tickers like FNGU, BULZ. These tickers haven't been around for very long, maybe since like 2018. And then I thought it had, no, I think those are the newest ones that are in it. But if you take this and test it, for example, well, I guess I should just keep another one open. So if you test this, for example, it's going to give you limited data. So it'll say 375 annualized versus 32% max drawdown. You just can't rely on that because that's only back to 2021. So if you look at that and then you look at the longer backtest version, only shows an annual return of 209, and even that's not going to be accurate. I would say your true average return on that one is probably somewhere closer to like 120 or 130%, as opposed to 209. So I think if you look at something and it shows you an annualized return, I would probably cut like 50, 60, 70% off of that, and that's probably what you're more likely to see on average. But it's just going to vary year to year, because even, if you take the S&P 500, the average return for the S&P is like maybe 11 or 12%. But if you look at like 2, 3, 4, 5 years in a row, it'll do 20%. You know what I mean? Let's see. Oh, let me look at, yeah, here we go. So like 2011, I already have the stats on it, so I'm just going to look. So 2011, 8%, 2012, 15%, 2013, 32%, 13, 1, 12, 21, -4, 31, 18, 28. So your average rate of return is about 12% on the SPY, but year to year, it's almost never the same. So that's kind of how I would think about your symphonies as well. They're never going to be the same year to year. So if you're looking at one and you're thinking, wow, that's a great rate of return, it's just not. Yeah, I can't stress that enough. Don't just assume it's just going to do 157% every single year. One year it could do 28, one year it could do 90, another year it could do -15. So that's kind of how I look at that, and that's why I use a master, because I think with a master you're going to have a more realistic expectation of what kind of returns you're going to get year to year, just because you've predefined how much risk is on each one. So these are pretty much all equities. Some of these are like 3x leveraged China. Some of them are in LabU, which is like a biotech leveraged ETF. Let's see. Some of these are leveraged Tesla, Amazon, that kind of a thing. So these are basically all equities. I know some of them have like 3x leveraged treasuries, but they're going to perform about the same as equities perform. So I would just consider this purely allocated to equities. I don't want to save this with those allocations. I'm going to make sure it's fixed. Come on. Okay, there we go. So actually, you know what? I'll do it this way. So for an example, let's pull up the leveraged / aggressive and then run the backtest on it. So, okay, so you have the leveraged and aggressive, and then I'm going to add the other ones as benchmarks. Okay, so there's that one, there's an energy one, emerging markets. So what was the other one? Oh, negatively correlated. I think that's all of them. So basically, you can compare all the individual symphonies together on a chart, and you're going to have a bunch of different looking equity curves. And that's kind of the point, because if you kind of go month by month, all of these are sort of all over the place. But some months, one will do much better than the others. Some months, some of them will be negative, some will be positive. And that's kind of the point, because you don't want all of your investing laser focused in any one particular market, because then, if we have a recession where maybe you have commodities and then you have equities, the equities could be getting totally wrecked while commodities skyrocket, or gold skyrockets, or something like that. So it's kind of the whole point of a diverse portfolio. Oh, you know what? Actually, this might even be better. Let's use the overall versus all of the benchmarks. That'll kind of give you a clearer view. Conservative, leveraged. Energy. Is that it, or I'm missing one? Conservative, energy. Oh, I don't want that on there. Negatively correlated, leveraged, energy, conservative. Oh, emerging markets. Here. Okay. So this is the master versus all of its individual symphonies. So the leveraged aggressive obviously far outperforms, and which it should, but it's also going to be the highest risk too. So, and so overall, you can see the overall portfolio is the highest performer at 40%, and then all of the individual ones are below that, and that's kind of what I would want to see. So let's kind of actually let's even get more zoomed out. Okay. So this, where does it start at? Here we are. Okay. So what I like to see is the Master Symphony is pretty much right down the middle, and that kind of shows you like the importance of the portfolio being diversified, because if you're all in on energy or if you're all in on emerging markets, you could have a super good month and then 3 bad months and you know, so on and so forth. But that's kind of the point to having a nice diversified portfolio. So I wouldn't necessarily just go all in on equities and then not have anything allocated toward maybe like gold focused or treasury focused or commodities or stuff like that. So and it's a good idea to kind of scroll along and just see, because like emerging markets, this one is just getting totally wrecked. But then you have your leveraged, which is up 7, and your other ones are kind of flat. Energy's a little bit down. And then the overall portfolio is still up. So that's the whole point of being diversified. So just kind of, it basically just spreads out your risk. So up 0.1, you got a few that are negative, one that's, so just that one group of the leverage and aggressive being up 4% basically negates all of these ones being negative, and the account was positive over, is this about a month? A little bit less than a month. Actually, it's like 2 weeks. So, and again, that's kind of the point of predefining the risk too. So the emerging markets, very low risk, and the whole point is because look how fast it can decline in just 2 weeks. But because you only have 6% of your account allocated to emerging markets, it doesn't drag the entire portfolio down, and that's kind of the point. I'll drag to, so these are all like 2-week periods. So let's see, we got 2 that are negative, 3 that are positive, 4 that are positive, and you have a positive 2 weeks, right? March 2nd to, yeah, about, these are like 2-week periods. They're pretty much all positive, so the portfolio is positive. But what's nice is, and they're all sort of uncorrelated, you know what I mean? So that's another thing that you kind of want. Like if you're gonna run a master, or even if you don't run a master, if you have you don't want to be running a whole bunch of symphonies that are correlated to each other, because then you're gonna go basically the same direction as the market. So it's just not a good idea. And then you can be stuck in a drawdown for the same amount of time that the overall market's stuck in a drawdown, so on and so forth. So this is the Master Symphony. So the beta is very, very low to each one. except for conservative, but that's 20% of the portfolio. So, and is this? This is like all of 2023, right? Yeah. So the beta to each individual one is relatively low, other than the conservative one. And then well, let me just do the SPY too. Then might as well. So even its beta to SPY is still pretty low, which is nice. And then if you look at the max drawdown for the whole portfolio, it's 1.9%, which is actually the lowest drawdown out of all of these. And that's kind of the point. Sharp ratio 5.39, which is super high. It's higher than all of the individuals except for the leveraged aggressive one. So negatively correlated, a negative 0.02. Let's see, what else? Standard deviation, 7.2. Again, lowest one, which is kind of nice because that'll tell you what the expected volatility will be of the whole portfolio. And the fact that it's lower than all of these, kind of nice. So Calmar, I don't really know anything about Calmar, so I don't really look at it. But if you guys pay attention to it, well, let's see what this says. A measure of risk-adjusted return, the annualized return divided by the max drawdown for the selected time period. Oh, okay, all right. Well, that doesn't do us much good considering this is only a year. So, but if you're looking at something that's tested over 5 years or 10 years. That's probably something important that you want to pay attention to. So, but yeah, so that's the whole purpose of a diversified portfolio. Any questions on that? And this could be much more diversified too, by the way. I mean, this doesn't even have commodities, gold, silver, that kind of stuff. Although it does have energy, which is good. Emerging markets, I think, is probably worth having a little bit of exposure to. Let's see. Are you thinking this kind of portfolio is set it and forget it for a few years? How often do you reevaluate the Symphony for optimization, and what would you look for? Yeah, I would say it is set it and forget it. This is something that I plan on running for, I would say, a minimum 5 to 10 years. How often do you reevaluate the Symphony for optimization? The individual symphonies, I wouldn't really reevaluate them. I would reevaluate the entire portfolio as a whole, because again, my risk is spread out and it's relatively low. If I see new symphonies that come along that could potentially maybe replace one of the symphonies that's already in there, I'd probably consider that. But if I'm going to replace one symphony for another, those two symphonies probably need to be correlated somewhat, because I don't want to lose that diversification of the overall portfolio. So if I'm going to replace something, I want to make sure that it has sort of the same correlation of the market that it's invested in. Optimization and what would you look for? I think if I had, God, hold on. The sun is like right in my face. What would you look for? I would look for, if I had a drawdown of maybe like, I would say if I had a drawdown maybe of like more than 3 or 4% in a month, I might start looking for which symphonies are causing that, and the fact that maybe I'm overweighted in those. And so I would probably look at my risk exposure to those individual symphonies. So let's say if I'm exposing 1% risk, I might take that down to like 0.75 or even like 0.5, but then leave the other ones at 1%. So I'd probably do something like that. So as far as what I would look for, I would probably look for individual symphonies that are performing really badly, and I would probably run them through quant stats and then look at sort of their weaknesses and if there's too much risk involved in the symphony, and then I'd probably look at I would probably look at their win months. If they have a sort of a low winning month percentage, I would probably factor that into how much I want to allocate towards those as well. But yeah, and then the other thing is, let's go back here. Okay, so I still have Interstellar. The other thing I was talking about earlier was how fast they recover from drawdowns. So I'm looking for them to recover from drawdowns relatively quickly. So if you look at like average drawdown and then average drawdown days, S&P average drawdown is 2% over 18 days, while mine is 1.1 over 4 days. So in other words, it's recovering from drawdowns relatively quickly, which makes sense to me because I've predefined the risk to each symphony. So, and if you actually look at daily returns here, you can see that it's the risk on the daily downside is you can see that there's a higher win rate on the upside versus the downside. So, and that shows up here in the 65% win rate. So 65% of the time you're having a positive day, and I don't care if it's 0.01% positive or if it's 1% positive. As long as it's positive, that's what I care about. And then, like I said, if your profit factor is, I would probably look for at least a 1.5 or higher. So the fact that mine is a 3.05 and you have a 65% win rate, most of your winning days are going to be larger than most of your losing days. And you can see there's only been 2 days, it looks like, so far this year where the portfolio lost more than 2% in a single day. Whereas there's been many, many days this year where the portfolio made more than 2% and even higher than that. It looks like 3 and 4%. It's hit almost 4% twice, and it's made, I would say, probably around 3%. 1, 2, 3, 4, 5, 6, 7, 8 times. So that's what gives you that higher the profit factor. So, like I said, that's the reason why I use a master, so that I can look at all the data for the entire portfolio, and I can make adjustments based on the things that I look for, like the profit factor, the win rate, which is the win days percent, all that kind of stuff. So I don't really care too much about the beta. I would like the beta to be a little lower, but there's only limited data here. So I think as time goes on, this beta might decrease relative to SPY. So we'll see. And then you can look at the worst 10 drawdowns, which probably give you a good idea. This is only over 1 year, but you can see most of the high drawdowns occur in the 2% range. And then it's only had these 3% ones twice, and these 1 to 2% ones 3 times. So, and then you can look at the days, how long they lasted. So, and that this right here, this will kind of give you the recovery factor. Where's the recovery factor? Where am I missing it? Oh, here we are. So recovery factor 28. So the higher this number, the faster you recover from drawdowns, which is nice. So if it's 28 versus SPY at 1.68, yeah, I would say it recovers from drawdowns relatively quickly. So, and again, if your wins are bigger than your losses, the faster you're going to recover from drawdowns. So, yeah.
Could you scroll up to the Sortino and Sharp on that screen?
Yeah, on this one.
Yeah. Okay. So so what I just learned is that Sortino divided by the square root of 2, two down from Sortino.
Yeah, here.
That 10.3, that's equalized with Sharp.
Okay.
so that you can compare the two. So
Hmm.
Sharp measures the standard deviation up and down, and where
Okay.
Sortino just looks at downward deviation from the mean.
Okay.
So when so that 10.3 being greater significantly than that 6.33,
Mm-hmm.
that tells you that most of the standard deviation is upward.
Ah, I
Um,
see what you're saying.
yeah,
Well, that's good
yeah.
to
So
know.
sharp, yeah. So sharp doesn't on its own, it doesn't tell you so much.
Okay.
Um, but when you look at those two, compared to each other, you can't compare Sortino and Sharp because Sortino on its own just that rules out the upward standard deviation. So they're not comparable numbers. But then
Mm-hmm.
Sortino divided by the square root of 2 makes them comparable.
Ah, that's interesting. Yeah, I never knew what Sortino, especially the square rooted one, but I never knew what it meant. So that's very good information to have. Thank you. So you're saying because this is,
Sir, can you explain that a little bit more? Can you break that down a little bit more?
Yeah, and I'm not an expert by any means, so it could forgive me if I'm wrong, but I'll give you an approximation. So Sharpe ratio looks at standard deviation both up and down. So it's deviation from the mean. And so if you have I forget,
I thought Sharp
so
was risk-free rate, or it took into account the risk-free rate or something like
no, it's standard deviation. And so like if you have an evenly distributed curve, I don't know what that does to your Sharpe ratio, but um, yeah, basically, you have as much up movement as you have down movement. So, your investment doesn't go anywhere. And then the Sortino ratio on its just the raw Sortino it looks at the mean and it just looks at um, the downward, the risk basically. So it just takes the deviations to the downward size because most people don't worry about, hey, if it's deviation from the mean going up, hey, that's great. That means I'm making money. But if it's deviation down from the mean, below the mean, then I'm losing
that.
money.
I see. Okay, I just reviewed the formulas. Okay, it makes a lot more sense. Okay.
hmm.
Yeah, and so that's Sortino divided by the square root of 2 equalizes the two measurements. That's equal,
They would be
like,
if the upside and downside.
right.
Exactly the same Sharp, exactly the same split. So divided by 2, up and downside equation.
Yeah, so when that's greater, this Sortino divided by the square root of 2 is greater than the Sharp, then that tells you there's more upward movement.
Yeah, I never thought about actually using a ratio. That's a very, very, very interesting thought. So very interesting. Like the ratio, curve. Basically, what you're suggesting is look at the ratio curve between the Sharp and the Sortino to give you a little more information. If I understand you correctly.
Yeah, so the raw Sortino on its own can't be compared to the Sharp because you're missing you're missing all the upward standard deviation. So the what is it? The denominator is going to be lower, so you're always going to have a greater Sortino
Well,
than you will
thing,
Sharp.
right? But the thing is that you would see that manifest in the portfolio return, and that's why I've always preferred Sortino myself. So you should technically still see but yeah, you're right because it's in terms of the downside return. I see. Okay, so this is
Yeah.
okay. Yeah, that makes a lot of sense actually. I didn't. That's a caveat that I overlooked. Yeah,
My-
thanks for pointing that out.
Oh, here we go.
Appreciate that.
Yeah, and then so the other thing is the ulcer index. I was just trying to read. Oh, ulcer is before this one, right? Where the heck did I see it? Oh, ulcer index. Okay. Ulcer index measures both the depth and duration of drawdowns and is one of the rare risk indicators that is path dependent. Its return adjusted version is a better indicator than the Sharpe ratio for investors who are more concerned by drawdowns versus volatility. I would say our community is probably concerned with both. More concerned by drawdowns versus volatility. Name of the index comes from the supposition that drawdowns cause stress and ulcers to investors. Ulcers calculated by taking the quadratic mean of the drawdowns, and then that's where it goes Greek for me, and I can't understand anything. Anybody else have anything to add on to all this intelligence? How has your philosophy on risk management evolved since you've been on this Discord? Were you initially more willing to take more risk previously? Yes, which is why the first strategy I ever made was, let me back up. The first finished final version of a strategy I ever made was the TQQQ for the long term because I wanted lots of money in a small amount of time. And I figured out that that's probably not the best way to grow my account. So, let's see. As far as being on the Discord, I just noticed that, trying to get out of these sunspots. I noticed that pretty much most of the users were sort of after the same thing. They wanted outsized returns with very little risk. And it was almost like there was sort of this, how do you, almost like unrealistic expectations, where somebody would look at a back test and just think, well, this is the way it's going to be in the future, and so let me throw a bunch of money at this and I'll be good to go. When in reality, trading just does not work that way. Once I started researching successful traders, especially reading the books, when I read Market Wizards, I really started to change my perspective on what trading really is. And it's really about controlling your risk and preserving your capital is really what I've gotten from all of these. I think I've only read 3 books now, but the first book was Market Wizards. And then I started reading also The Man Who Solved the Market, which I mean, well, I haven't finished the book, but they don't really talk about risk that much, but they really focus on sort of strategy design and that sort of a thing. And when I came into this, I just sort of had like a tunnel vision, I focused on equities, I focused on leveraged ETFs, and that's all I cared about. But that's just not, I don't think that's realistic. And the more I'm learning, the more I'm figuring out that if you're not going to predefine your risk, and if you're not willing to wait for a successful strategy to materialize, you're going to lose, or you'll just quit. And so the more videos I've been watching, especially this one that I recommended earlier, this Tom Basso one, it's more appealing to me to have a successful strategy where the risk is defined and it's relatively lower and you have to give the strategy time to materialize. And so yeah, my perspective has completely done a 180 since joining the Discord. But I mean, that's the whole reason why I kind of did all this, because I wanted to learn more about the world of trading. But yeah, the more I read the world's best traders, the more I figure out they kind of all have the same sort of mentality. And what I took away from that was, number one, preserve your capital. Number two, predefine your risk before you even put a trade on. And most people just don't do that. That's the reality. And that bears out in the statistics. Were you initially more willing? Yeah, I was for sure. In the beginning, I was initially more willing to take more risk. And by the way, I'm willing to take the same amount of risk with less money. You know what I mean? So if I came in with $100, I didn't care if I had a 40% drawdown, because I just looked at it as $100. However, if you have $10,000 and with a 40% drawdown, you're going to feel it and it's going to hurt. So, or $100,000 or whatever, whatever percentage of your world starts to hurt, it's all about percentages. So I just think of everything in terms of there's a random, and I learned this from Mark Douglas, who's freaking one of the best traders or coaches that I've ever seen, and his videos are just absolutely amazing. If you watch these videos right here, you will learn so much about yourself and also about the way you look at trading. I played this clip. It was a pretty short clip, but I played it last time on the last call. Are you guys interested in why? It's just a couple minutes, but if you guys don't want me to play it, I can just link it, or if you want me to play it, I'll just play it. All right, fair enough. Yeah, so anyway, this is very important what he touches on right here. I know it's blurry, sorry.
Most people who experience the boom and bust cycles,
Can you guys hear it?
would say that something happened in the market to a trade to acquire a good methodology with normal losses.
Okay, here.
Drawdowns are a reflection of what?
Right here. There we go.
You've got your consistent winners. Now, it doesn't mean that there aren't drawdowns here, okay? But what do you think these drawdowns would be a reflection of for the consistent winners? Consistent winners take losing trades all the time. But their drawdowns are a reflection of what? Anybody got any ideas? Yeah, money management skills, capital preservation. Okay, these are two.
Guys, I'm gonna let this play real quick, but I'm just gonna go use the restroom, so I'll be back in a minute.
Good answers, but not the answer I'm looking for. Their drawdowns are simply a reflection of the normal losses that any trading methodology will incur. There is such a thing as normal losses. You don't have to write this down, because we're just starting to scratch the surface. We are going to go into this in far more detail later on. So, I mean, if you guys want to write it down, that's fine, but it really isn't necessary. Okay? Normal losses that any trading methodology will incur. Then you've got people who learn something about how to trade, to acquire a good methodology where it is possible, based on that methodology, to experience a consistent income, but your equity curve might look more like this. Most people who are experiencing the boom and bust cycles, which are the bust cycles, would say that something happened in the market to cause this. What you're going to find out today is that it is not the case. Even though it may seem like it, it is not the case. These are virtually always the result of trading errors, what I call trading errors, which we're going to go into in detail later on. One of the, just for the gentlemen, few people back here that don't have any idea of my background, I'm going to go a little bit further in it, and I'm just going to jump ahead for a second. I ended up being a trading coach and working with. I was a trading coach for probably about 17 years. I don't really do it much anymore. I just pretty much focus on my own trading. But while I was, especially in the throughout the 80s and most of the 90s, I worked with a lot of floor traders, and we talk about boom and bust. There one of the floor traders I worked with was probably one of the 5 biggest bond traders at the Chicago Board of Trade. And when I met him, was in like around May of 1992, and from January of 92 until the time that I met him in May of 1992, he had around, this is a guy that just traded for himself. He didn't trade for a firm. He just traded his own account on the floor of the Chicago Board of Trade in the bond pit. He had $12 million rolling in and out of his account. And he had a particularly bad day, and he ran into somebody who attended one of my workshops and said, hey, you should go see this guy. He called me. We had a few appointments. It didn't really go anywhere. And the next thing, about a month later, I get a frantic call from his wife, who I hadn't even met, didn't even know who she was. Got a frantic call from his wife that said, they're going to lose their house if I don't do something with him. Okay. he had another real bad day. So anyway, I started working with him in July of 1992. And from July of 1992 until the end of the year, he ended up the year with almost $6 million. Now, that may not seem like a lot considering he had these swings, but he'd never finished the year with more than, I think, around $650,000 or $700,000. So he had just under $6 million. And so then he went on vacation. He happened to take a book with him called The Coming Collapse of the Bond Market. This would have been in like late December of 1992, early January of 93. And came back. Now, if anybody remembers the bond market back then, it rallied to spectacular heights. But in the meantime, he'd read this The Coming Collapse of the Bond Market, so he's going into the market every day short, okay? And pissing away the $6 million until he got to the point where he had about 2 of it left. And it took him about until maybe mid-February. And he was so exasperated that he said, hey, you know what? I'm willing to do anything. And now keep in mind, I'm willing to do anything. And it wasn't lip service. It was real. It was genuine. It was sincere.
So, yeah, anyway, that's Mark Douglas. He worked for, I think, Merrill Lynch. He was a trader for Merrill Lynch. And then he went on to be a trading coach and blah, blah, blah. Anyway, he's written several books that are extremely good. I think one is called Trading in the Zone, which I read, and that really helped me develop. Yeah, Trading in the Zone, this book right here. This really helped me figure out how to build these master symphonies, how to allocate my risk to which, to defining how much risk I was going to take on each one and all that stuff. But this book really, really helped me kind of figure that out. And so, yeah, I have a completely different perspective than when I first came in here, and it's just really, really helped a lot. So I highly suggest that book, Trading in the Zone. It freaking helps so much. Let's see. Just a general composer strategy question. Do you plan on scaling funds into this portfolio over time as composer proves to be stable and the strategy proves to be profitable? Yeah, absolutely. That's just all the money that I have in it right now. It's just that's what I've got to trade with right now, so that's what I put in there. But any extra money that I get, that I don't need, I just put it in my Composer account. So in February or March, when I get my tax refund, I'll just put it in my Composer account and just let it trade, because I wholeheartedly believe in the strategy that I've built, and it's just comprised of pretty much a whole bunch of strategies that exist inside of our Discord. There's nothing special. There's no magic one that, you know what I mean. It's just it's like 99% strategies that are already floating around out there. So this is also kind of why I keep suggesting we could really use stops. Would be curious to get your thoughts. All great reads, by the way. Is this question for me or for one of the other guys? Was in reference to the market wizards. Yeah, for you. All right, let me read it again. Also kind of was suggesting we could really use stops. We could be curious to get your thoughts. All great reads, by the way. Stops, yeah. A stop is a stop loss is what? It's predefining your risk, right? Let me do something real quick. I did this on the last call, and I hope I don't want to bore people, but I think it really is important. I'm just going to pick a individual company ticker. Let's just go with Netflix. Let's see. Okay. I'm just going to use one example of, so let's see. I wonder how far back I can go. Okay, so I'm going to use like a manual trade. This would be an example of a manual trade, and it's an example of position sizing and predefining your risk. So let's say I have an account of, well, first let me lay out this strategy. Okay, so the strategy is the price has to be above the 200-day move average, and which is this blue line here. So price is here. So this would be an example of an opportunity to take a trade. So price above the 200, and the MACD, or the percentage price oscillator, has to be below the 0 line, which is here. And then there has to be a crossover occurring below the 0 line. So if these three things are met, this would be an example of a trade that I would take as a manual trade. So if I enter a long position here, you have to predefine your risk, and you have to use position sizing so that you're not, so that you don't blow up your account after 4 or 5 trades or whatever it is. So let's just use this as an example. This is I forget where it comes from. I think it comes from here. Actually, no. Yeah, this button here. So this is a long position. This is like a shortcut. So anyway, click long position, and I would put it on that this is a 1 hour chart, by the way. You could use it on any time frame, but I'm just using 1 hour for sake of more opportunities. But anyway, the way that this particular strategy works is when you put the trade on, your stop loss is going to be below the previous swing low, which would be at the bottom of this green candle here. So that's where the stop would be, and then the risk to reward ratio would be 1 to 1.5%, meaning I'm going to take a 1% loss like I do in my Composer, and I want my reward to be 1.5% of my risk. So if my account is, let's say it's, I don't know, 20,000 bucks, I'd enter $20,000 right here, and then lot size 1, risk 1%, and then I want my reward to be 1.5%. So you would set a take profit target at 1.5 times the stop. So the stop is 414 ticks. So I would go to the set. So you click on your, you click in this, anywhere on this little setup here, and then hit the settings. And the stop level is 414 ticks. So I would do 414 times 1.5. 414 times 1.5. That gives me 621 ticks. So I would do, my take profit level would be 600 and, what did I say? 21? Yeah, 621. Okay, so 621 ticks would be my take profit target. And so you'd put the trade on, and then you would let it ride out until you either A, hit your take profit target, which is right there. So if, and this is, like I said, this is a 1 hour chart. So you would hit your take profit target in the same day, and you'd be out of the trade, and then you would wait for the next opportunity. You don't have to get out of the trade completely. You could take some off the table and let the rest of the trade ride, and blah blah blah. Obviously, it just depends on you, but that would be an example of like one successful trade right there. You predefined your risk and you predefine your take profit target. So that would give you a 1 to 1.5 risk to reward ratio. So you were risking $200 to make $300. You can see the amount right there, 20,300 would be your new account size if you won the trade, or if you hit the stop, the account size would be 19,800. So you're risking 200 to make 300. And that's just one example. So if this strategy, I think I found it on YouTube or whatever, and it's just kind of a simple strategy to follow. But basically, this strategy has like somewhere around a 60% win rate. And so 60% of the trades are going to be winning trades and 40% are going to be losers. Now, here's the kicker. If the win rate was below 50%, you could still have a profitable, your account could still be profitable because your wins are larger than your losses. So even if you, I wish I had a freaking graph to show it, but it doesn't matter. But that would be an example of following what he was describing in this video here. That would create a steadily rising equity curve like he was talking about. So basically, that's a win, and then you would wait for the next opportunity, which is right here, because the price is above the price is above 200. And then you see this crossover down here. It's below the 0 line. So you put the next trade on. So now you would do the same thing. You put the trade on at the close of the candle, which is there. You have to adjust the account size. So the account size is 20,300. Yeah. And then same thing. You put your stop at the low of the previous, or at the previous swing low. So at the bottom of that. The bottom of that tail of that candle. So that's your risk. And then we would make the risk 1%. So if the trade is a loser, your account size is 20,097. So you still have positive equity from when you started. And if it's a winner, let me make sure I adjust all right, so the ticks. So you're risking 737 ticks. 737 times 1.5. Okay, so 1105. So 1105 ticks would be your take profit target. And that's what your so that's what the trade would look like right there. You put the trade on, and 1, 2, 3, in about 4 hours you would have hit your take profit target, basically at the open of the next day's candle. So that would bring your account to 20. What's up? Okay, so anyway, that would be another winning trade. So you got 2 winners in a row, and now your account's at 20,604. So just to sum it all up, this is how you would create a steadily rising equity curve with relatively low drawdowns, and that's kind of the point of all this. You're just predefining your risk instead of just looking at this and going, okay, I'm going to jump in here and put my stop here, and you don't really have a plan. You kind of just I'm going to throw $1,000 at it, and You know what I mean? Like that's just honestly that's most traders. They just kind of go with the flow, and there's no real plan. But again, there's other ways to do that. You don't have to completely get out of the trade. Like I said, you could take 50% off the table. You could take 25% off the table, and let the rest of it go until it hits a certain level where you feel comfortable or whatever it is. But you have to test your theory or test your strategy over a series of trades and figure out if it's a winning strategy or not. And if it's not, just go back to the drawing board and just kind of reevaluate what your system looks like. But that would be one example of a trading strategy like that. So use stops. Would be curious to get your thoughts. Oh yeah, so I was basically answering that question with this an example of 2 trades. And like I said, I just randomly went to Netflix and I just looked for a couple of setups and I took them, and that's what it looks like. So that's 2 wins right there. Like I said, that particular strategy has about a 60% win rate. But if your wins are bigger than your losses, and the way you can make your wins bigger than your losses is by predefining your risk. So picking a stop target and then making your profit target larger than your stop, your winners will always be bigger than your losers. And so I think I read somewhere that like most of the successful traders in the world, their win rates are around 45 to 50%. But their wins are so much larger than their losses that the strategies are extremely profitable, even though they have a win rate that's lower than 50% or around 50%. So it's really about your system and predefining your risk, and that's how you preserve your capital too, is by your stop losses and taking profits at an appropriate time, that sort of thing. So and again, you don't have to do. Your risk doesn't even have to be 1%. You could risk 0.3% of the, it won't even let me put in a decimal, but your risk doesn't even have to be 1%. You could make it smaller than 1%. So if you want much lower drawdowns, just take much lower risk. But yeah, I think stops would be nice, but I think if we did have stops in place, our strategy designs would start to change, or they might start to look different. But yeah, stops, if you're going to be manually trading, stops is like, if you don't have stops, I just think you're crazy. But that's the whole reason why I talk about the portfolio allocation to specific symphonies. That kind of acts as like a stop. And that's why I use the worst day performance and all that stuff. So in your opinion, why does our community not just DCA and SPY, given most strategies lose money? I think because people are looking for a way out of the norm. That's what got me into starting to design strategies. I just figured, well, what's a way that I can make some money if the market's going down or going up? And so, I mean, that's honestly, that's the reason why people don't DCA into SPY. They're looking for a better alternative. They're looking for outperformance. They're looking to make more money in a smaller amount of time. And I mean, you can do it. It's just you need to put in maximum effort and really, really figure out a winning strategy. And there's tons of winning strategies out there, but the problem is, given most strategies lose money, the reason why most strategies lose money, again, is because the overfitting, people YOLOing way too much money into a strategy without understanding what they're getting into, what the risk is. They're not predefining their risk. They're just throwing money at stuff and seeing what sticks. That's just the reality. So, yeah, you need to really educate yourself and you really need to design your own portfolio in such a way where you're going to steadily grow it and with limited risk. I don't really know what else to say on it, but what, in your opinion, is the most or best diversified strategy that you made or found on the Discord, and what makes it great? Honestly, I think it's hard to say, but I'd probably have to give a shout out to Proteus and his freaking micro blob strategy. I've liked all of his blob strategies, honestly, because it just seems like he put in a lot of freaking effort and a lot of time and a lot of homework into him. Where is here it is. So this is the out of sample. So I've been tracking the micro blob one since October 9th, and it's grown 41%, which is freaking awesome in a small amount of time. And this is since they've came out with the dynamic sorting. So, but if you guys haven't looked at it, it's interesting. It's almost a little bit too hard to wrap my head around, but that would be an example of a steadily rising equity curve, right? I do think the risk is still pretty, it's super high for sure, because it's making 1 day moves of like 1, 2, 3, 4%. So that means it could go the other way too. So to me, that's extremely high risk. Even though it has a very low max drawdown, it just is what it is. 20-day max drawdown, select bottom one, and that's out of a group of 1, 2, 3 different setups. So bottom one, top 3, and top 2. So 5, 6. So it's selecting the 20-day max drawdown out of 6 symphonies. And these are all just dynamic sorts. So Derek the Bond Whisperer, version 1, Safety City, All I Want to Do Is Short, Wooden Arc Machine, Tim and Elon's Excellent Adventure. So they're pretty much all the same. I guess there's slightly different variations of the same symphonies. So it's basically using the same 1, 2, 3, 4, 5, 6 symphonies. So, I mean, it's very hard to create something that looks like this and performs that well out of sample. So, I mean, my hat's off to that one, because that's freaking hard to do. Let's see. But there's a lot that are doing well out of sample. If I go to my oldest ones and look at my cumulative returns, like this one, I've been tracking this one since 2022, and it's up 127%. And this one was more based on a theory that I had, but it's up 92% since out of sample, which is around January. But yeah, there's plenty out there. Most of them are trend following. Like this is trend following. That's 100%, 84%. This is just TQQQ for the long term. It used to have a different name. 82%, 65%. These are all trend following. Elon's Excellent Adventure. This is just a specific version of What More Do You Need? So yeah, I mean, it's hard to pick any one. But that one Proteus made, and then most or best diversified strategy that I made. I mean, the one that I would just say my master symphony, just because it's invested in a bunch of different symphonies. And so far I've been having a lot of success with it. But I do look at it every day. I do think about how I can make it better, how I can make it less risky, how I can add more diversity to it. The problem is right now, I would say my biggest problem is symphony size, because you can only have a certain, your symphonies can only be a certain size of code before you can't save them anymore. So that's my biggest problem I have right now. So I may have to do like 2 separate masters or something like that.
A good question on the Proteus Symphony. Hey, Proteus. The question I had, actually, I've looked at your symphony in the past, but I guess I didn't deep dive into it. But is that basically a mean reversion of other symphonies? Like whatever the worst symphony is, you just buy that because
Yeah, it's only gonna work if they're kind of bouncing.
That's only gonna work if they can, so use RSI to filter that.
Right, which doesn't really make a whole lot of sense. That's not a, it's not
I see, okay.
now it's not doing great. It's down 50%. A whole bunch of them. Yeah. Which is down a lot this week.
Right.
The way I advise that, because that isn't the commercial strategy. And so it seems that get it moving down, so they just move it back as it goes down. But we don't know how far down it goes.
Yeah, it's 66%.
Interesting stuff. Yeah, this is also something I was thinking of myself as well long ago, but I guess ever since Composer has these extra tools, yeah, there's other possibilities. Yeah, really nice job.
But that's why I don't have the RSI filter up. The others are for returns that way.
So if there was a way to do like, k-mean clustering, or if there's a method to look at the correlation or something where it's like, so for example, right now, I think the way to improve this particular symphony would be to, if you could invest a little bit, like if everybody's, like you said, going to yen, then yeah, if you could eliminate that, right, and sort of diversify a little bit more, that would be sort of the next step. I'm not sure if there's any tools that Composer allows you.
Improving WAM. That's great.
WAN?
WAM.
What is WAM?
Wooden arc machine.
That's the one that's, looking for the most stock at the list. Yeah. That's by far the most fastest.
I see. Cool. Very cool.
Fix that. So just get rid of,
I'm having I can barely hear you, Proteus. Like the volume is super low.
Is that better?
Yeah. Oh, I can turn your volume up too, I guess. Try now.
Yeah, I think I just need a new audio.
Okay. I can hear you much louder now. Okay. So the one thing I will say is that it doesn't as far as diversification of symphonies, it's pretty diversified. And then but then it's like current holdings, it only holds like what, 2 or 3 tickers or something? I guess it's right here.
Well, I guess my point is that yes, it is fairly diversified, but if all the diversified funds that you're investing in, if all of them are going into the same thing, it ends up being not diversified.
Right. It's very, very, very much not diversified at the moment.
Yeah.
And so the amount that it's been buying yen this week keeps going up because more of the logic keeps identifying yen as the most beaten down possibility for a meter version. Which, who knows? Let's see what happens Monday. But
Right.
um,
Is it because of the they brought back the mask mandates and stuff in China? Is that why?
there's been a lot of things going on in China lately.
Okay.
They've had real estate issues. They've had outbreaks of a combination of new infectious diseases
Mm-hmm.
that have affected people that have lung damage from COVID.
Okay.
Yeah, they're also talking about a major stimulus, so that could make a lot of the stock market bounce.
Yeah.
We'll see.
Gotcha. Yeah, I really like it. I think obviously, and people have had a lot of success with it running live too, right?
Yeah, I've been running it since September 26th, and except for the day when it failed to trade and I had to liquidate,
Yeah.
it's been up about 42-45%, something like that.
There you go. And so it looks basically it's tracking accurately.
Yeah, it's tracking the back test very closely. It's only off by 0.5% or 1.5%.
Okay.
In that range usually.
Gotcha. Yeah, I think
Most things don't track that closely, and it's really strange that something like this, which is made up of so many crazy things,
I agree.
actually ends up tracking pretty well.
Mm-hmm.
So the reason I think it works is because every individual that makes a symphony is going to have ups and downs. And, there's some sort of logic that usually always works. If you're buying the stuff that's beaten down, that logic eventually will recover. So it's, I
Mhm.
don't know. I sort of feel like it does logically make sense.
Yeah, so if you try putting other symphonies into these sorts in combos like this, a lot of them just won't work because they'll go down and down and down for so long. Then more and more funds just get uh, invested in those. And when you're trading daily, I mean, you're realizing your losses every day. It's not like
Mhm.
buying a stock when it's down and then
So-
running it back up.
Right. So you do the smart thing where you make sure there's a bounce first before you go in it.
I mean, ideally, that would be, but it's hard to do that with just simple RSIs.
Ah, I see.
But if you also have other filters, for example, for the 10 or 14-day cumulative
So you-
curves, then
So
you can
basically, you need some
see
sort of
what's popping and what's the most beaten down. So
Right.
you have like 2/3 are what's popping right now, what's been working the past few days, and then take a bet on one thing that's beaten down and coming back up in a mean reversion.
Oh shit.
But if you were to add if you had a magical method to add functionality to Composer, would it so that you can improve this algorithm? What would it be? Would it be some sort of stateful, some methodology to add state, or not really?
State. So
So you can
Well,
sort of track
tracking-
tracking the state of it. This is currently undersold. This is currently still going down, and then the
Right.
state, okay,
yeah,
it's
with more sophisticated indicators, more sophisticated logic, yeah, that would be ideal. Where it's not just beaten down, but there's some reason to think it's not going to just keep going down forever. Or I mean, how long has it been going down? Because something can be oversold for a very long time. And yeah, it remains to be seen whether this will all fall apart because the WAM logic just all goes all in on yin for the foreseeable future, or what. It still hasn't gone outside of the max drawdown from the backtest, so we shall see.
Yeah. Yeah, and that's just another reason why people need to they just need to really define how much they want to risk on strategies like that. But I think it's a super good strategy. There was another one I was gonna talk about. This one. This was like one of the first ones that Rogan posted that he made. Version 1 alpha of BWC Market Assassin. You guys familiar with this one? This one's pretty solid as well.
This one looks pretty simple.
Yeah, so this is basically just a mix of two symphonies. It's WHAM 3-year backtest and then T triple Q or not. That's pretty much all that's.
You made a B version of it too that was a little bit better.
Oh, really? I don't know if I've seen that one. It's version B, is that what you said?
Yeah.
Okay. If you have it, could you post it in the chat?
Yes.
But yeah, I have this one as part of my it's part of my master, and I think I have like 7 point something percent on it. Something like that. Where is it? Oh, right here. Oh, 11.4. I think it was 7 at one point, but then I reduced the size of Shiv, and then I allocated more to the other strategies. But yeah, so I run 10. I run 10 strategies in my master. That's it. Probably would run more. I just can't. I can't save it. It won't save. But yeah, this one's really cool, and it is pretty simple. It's got this. It's got WHAM. Basically, WHAM just breaks down like this, and then it's got this TQQQ or not, which is pretty interesting. Although, one thing I don't really understand is replace UVXY with SOX-S. That doesn't make sense to me. 10-day RSI TQQQ is greater than 79. Short semiconductors, I don't really understand that, but me personally, I would just, I like using UVXY, but that, I mean, that's really the only thing I don't understand. But everything else in here is just 10-day RSI of 2QQQ is less than 32. SOXL, 10-day max drawdown of TMF is less than 7%. It goes SOXL. I don't really understand that either. But, I mean, it seems to work, so.
Sorry, are you asking why are those replaceable? So UVXY is basically VIX, right?
Yeah.
So SOX-S is shorting semis. So semis have the highest beta among all the different. So it's very, very correlated, is what I'm trying to say.
Correlated to what, though?
Correlated to
To market movement.
Yeah. So I think SOX-S is basically the same as, not the same technically, but if VIX is spiking, SOX-S might even grow even more.
Yeah, so I work for Lam Research in demand profiling for the Simmings.
Mm-hmm.
And what I see is like whenever NASDAQ goes down, it's directly correlated with market movements. So like this past week, AMAT was shorted quite heavily. I think it was like maybe 20% of their stock, which is why a lot of the companies had weird signals this week,
Mm-hmm.
which ended on Friday. So like my company has an all-time high, but our profits haven't been that way for over a year. So it's very, very interesting, and that's kind of why I think he changed that signal as well.
So, now, is this likely to continue being this way? Having the
Yep.
highest beta?
Yep. Semis are always going to have a higher beta than so you have basically S&P is S&P, beta is 1. You
Uh-huh.
have NASDAQ, which is always going to have slightly higher beta than S&P.
Uh-huh.
Then you have semis. So NASDAQ 100 is not purely all tech. They have a mix of some ones like biotech and stuff. But semis are pure tech, pure. And that's why they have the highest beta.
Wouldn't
So
tech be pure tech?
tech is not pure tech. If you look at NASDAQ 100, it has a bunch of, tech-ish companies, fintech, and I don't know. They're not really tech.
But what about like TECL?
TECL is only a bag of like 10 companies. It's not, Microsoft. They actually have cash. They got Apple. Apple and Microsoft are the biggest holdings in TechL.
Okay.
As an example. But that TechL is not diversified at all. But
Okay.
stocks is very diversified. Diversified as one can be in a sector.
Okay. Interesting.
And so what he means is like I'm an equipment maker, or my company works as an equipment maker, but there's also NVIDIA, which is just, we'll say, on the edge of chip design. So they really almost like a commodity and also a mixture of tech companies inside of them.
Right. So if you actually pull up NASDAQ 100, you'll see, other than the Magnificent Seven, you'll see there's a ton of companies
Yeah.
that are not exactly
Ah.
fully tech. They're not pure tech.
I see what you're saying. Okay. So SOXL's beta to SPY is higher than TECL's beta to SPY. And then, so is that why he chose SOX S for that?
Well, yeah. Well, there's two reasons. Number one, it's leveraged. So SOX-L is really a leverage of SMH.
Right.
The underlying true ETF is SMH.
Mm-hmm.
But with VIX, you can't leverage VIX. You know, at least, or maybe I don't know. Is UVXY 1.5 leverage? I don't know.
Yeah, I'm pretty sure.
I forgot. I think there's a VXX or something. That's
Yeah.
1.0 leverage, and UVXY 1.5. But you get sort of the same thing with SOX S, but you get 3x leverage. So it's he's trying to turn the knob up double. If that makes any sense.
Yeah, it makes sense, but I'm wondering. I guess it wouldn't be SOX S, or it wouldn't be SOX. It would be SOX S. So are you saying that UVXY and SOX S will perform the same way? They'll be correlated?
Highly correlated.
Okay. All right. That's starting to make sense now. Starting to make sense. So this is
Obviously the VIX can sort of be flat while the market keeps going down. So technically they're not always going to be correlated, but
yeah.
like if there's a delta, we'll see the spikes correlate.
Yeah, I agree. This is UVIX and SOX S. Yeah, it definitely correlated, that's for sure. Okay. Now it's making sense. I guess, so why use the 10-day RSI of TQQQ? If semiconductors have a higher beta to the market, why not use SOX L?
Well, remember, QQQ is always going to be an index.
Yeah.
Things will move based on indexes more than they do sector allocations. But, that's probably worth a try.
Okay.
Maybe
I see what you're saying.
There are some theories that say that the semis, which are pure tech, they have a little bit of a foresight.
Uh-huh.
So that's definitely a theory to try. But a lot of people look at the indexes more than they do individual sector.
Yeah, okay, that makes sense. Yeah. Nice. Okay, so version, this is the one I was thinking about.
Con mua hay mẹ mua?
Let's
Mẹ
see.
mua đúng không? Của mẹ đúng không? Mẹ mua đúng không?
K1 free.
Mua cho cả nhà đúng không? Con có lấy tiền con mua không? Con trả tiền không?
Significant.
Con cái chơi được không? Con không trả tiền thì con phải là giùm con chứ. Bài mình bài đi kiểm chụp hay nào?
Let me add.
Hey Ting, you're unmuted, man. Hot mic. Ting, if you can hear us.
Market ass. Interesting. So that's the more, I guess, so that's the new version.
So Derek, do you understand the theory behind it? I mean, maybe you can break it down a little bit.
Yeah, in terms of how you were comparing SOX S and the VIX?
Well, no, just this one, BWC. Like, what exactly is it doing?
Oh, here, let me close this one. Okay, so at least for this portion, yeah, he's checking the oversold conditions of the Nasdaq or the 3x leverage Nasdaq, which is that comes right out of TQQQ for the long term, and then so if it's about to revert to the downside, he goes short semis, which makes sense. And then the rest of these, go ahead.
So yeah, I guess I was thinking like the top level logic,
This one?
like yeah, like the all the way to the top, like so if you
Oh, right here.
Yeah, yeah, like what exactly is the overall logic?
Current price of SPY less than the 5-day move average. That's like super short-term downward trends, basically. Because if we take SPY and plug in a 5-day move average, it's going to be super volatile. So I think he's looking for quick moves, I guess. So 1, 2, 3, 4, 5, 6, 7, 8, 9 days below the 5-day move average. Here's one, and then it reverted back to the upside. 1, 2, 3, 4 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 days below the 5-day move average. Yeah, that's, I mean, yeah, it's just a super short window, but basically, so if it's below the 5-day move average, it just changes the weightings to the symphonies. It's still using the same symphonies. It's just, it's going to be weighted more in TQQQ or not under the 5-day move average of SPY. So it's just going to be either shorting or going long. It's really about it. But overall, it's just using the same the same two symphonies.
So this is more of a momentum play. It seems like just switches to the best momentum based on conditions, something like that.
Yeah, pretty much. But it's, I mean, to have simple, relatively simple logic, to have only a 10% drawdown using 3x leverage over the course of a year, that's pretty impressive. And you can tell it's going to be high risk because that 34% standard deviation. So, but yeah, I do like that one a lot. Let's see, I had missed some stuff up here. Stimulus. Oh, that's another one. A mean reversion strategy like WHAM is good to balance trend followers. The question is, as Proteus said, how far will it follow poor performance down? How do you break the cycle? That's where putting the max drawdown filter ahead of everything comes in. I've just struggled to find anything that works well as a counterbalance in that filter. I have to drop off. Thanks, Derek, for this wonderful session. Hey, thanks for stopping in, man. Appreciate it. This is the one I was thinking about. Okay, I saw that. If you want to maximize your gains in a mean reversion, it makes sense to use the highest beta ETF you can find that will move in the intended direction, given that UVXY tends to gain when the market is overextended, and so does SOXS due to a high beta. SOXS gives the largest return, I guess. I mean, let's test it out. Where am I at? Here we are. If 10-day RSI of TQQQ is greater than 79, stocks S. Okay, so this, well, let me look at the cumulative return. So 77% since 2011. And if you do, I think the problem is UVXY makes bigger jumps than SOX S does a lot of the times. 77% versus 1489%. Because and the reason why I was using UVXY is because the big single day moves, a lot of times they're like astronomical. Sometimes it's like 50%, 20%, you know. Like you go from negative 0.07 to 8.5% over like 4 or 5 days.
If you put them on top of each other, UVXY and success, what's it look like?
Oh,
Versus SQQQ. Can you put all three of them on one symphony? So SQQQ, UVXY, and SOXS.
yeah, here, let's try that. UVXY test. We'll save that. And then SOX S. Test. Save that. And then what was the other ticker?
SQQQ.
Oh, SQQQ. Okay.
Right, because technically, if you're gonna signal off TQQQ, it'll be interesting to see SQQQ's performance.
Yeah. Okay. I'm pretty sure UVXY will like blow them all out of the water, but let's okay, so let's overlay all of these. Okay, so test. You know what? I do have to say, I'm very unhappy with their search filter. I type test and I'm getting all this crazy shit.
Maybe searching the descriptions or something.
Do what
Instead of
now?
the title. Maybe searching the descriptions instead of the title, or and or.
How do I do that?
I don't know. There's no way. I'm just saying maybe the bug in their system is that it searches not only the titles but also the description.
Problems. I think you have to refresh for them to fully save.
Oh yeah, that could be it too.
It's really annoying, and then it finds it.
Okay, so now I have all three, right? Let me go to 2011. What the frick?
I think some of them are not present. Some of
Right.
the tickers may not. You don't have box selected. You do. Or you do.
Sometimes it just messes up, honestly.
Oh, no, you have to check those. Check the box.
Yeah, that's what I'm saying. They were already checked.
Down your tickers.
Here?
Go back to add, and check the box.
Those are just the raw tickers.
Yeah, these are the individual tickers.
Yeah, but I think you have to check them in order for them to show up.
No.
This has done it to me before. Hold on, let me just refresh the page. Go, baby,
I
go.
get a little bit through Raycon's new tool that allows to compare symphonies via Quantstats and look for.
Oh, that's true. There they are. 2011. Yeah.
Damn.
Yeah, it's not even close, dude. Well, that's what I'm saying. The 1 day moves are just insane on UVXY when it does have those spikes. And
Wow.
UVXY started way after. But they all are correlated, that's for sure. Yeah,
You actually basically VIX.
VIX futures. Yeah, it's God, where is my shit? Here we go. Yeah, short-term futures. So, like, see,
So interesting. So Derek, can't you just invest this in this one symphony? Like basically just this? No, not this one.
the UVXY?
Yeah, the UVXY.
Yeah.
You're a millionaire in no time.
Well, the problem is you'd have to be waiting a very long time for those moves because you have months and months and months at a time where it does nothing, and then you get your jump, and then well, yeah, I mean, if you have the
What's the
patience,
drawdown? What's the drawdown on that strategy on the UVXY?
21%.
Damn, that's pretty good.
Yeah,
25% CAGR.
I
Holy crap!
I think there was
Insane.
a
One.
one.
That's an amazing strategy by itself.
Well, that was and that was why I put it as a front runner to all the other checks on TQQQ for the long term. It's so funny. I was actually just looking for this the other day. I found so what I did, I think it's called like Total Trading System or something. Right here. So this just does a UVXY check, right? That branch. Like how we were just looking at.
Mhm.
And then Teckle, same thing. It just looks for one condition on TECL. This just looks at the 200-day moving average and invests it. So basically, they're like individual branches from different symphonies. This is just a 60-day RSI check. Bear market strategy. What more do you need? So I think these are all just, let's see, except for that one and that one. So these three right here, I didn't make these three. These are other people's. But the rest of these are just strategies that I had made and then put together in one master. And oh, I don't like the oh well. Anyway, it's just like a kind of a simple, you know what I mean? Like it's not very complicated. But these you could literally run them on their own as individual strategies, like you were just saying, and they'd be profitable. There was another one. Are they in my watch list? Yeah, they are. So there were some ones that I made sort of like that, but they were just RSI strategies. Yeah, like there's this one, which is super simple. So current price greater than 200-day, 10-day RSI, less than 49, 1-day cumulative return less than -2. So there's a percentage price oscillator strategy, which is basically a MACD strategy. And then the rest of these are just like simple TQQQ or SQQQ. That's UVXY. Let me see. See, that one's pretty good, 61,000%. a lot of it's just based on like one day jumps. Yeah. But anyway,
I'll take that. I would take that for the curve.
yeah, dude, for sure. Yeah. You know what? I want to see what it looks like on the logarithmic. Okay, I'll run this, and then after this, I'm going to jump off because I can hear my daughter starting to get impatient.
Can you share me your symphony we went over today?
Yeah, which one? Which one? The master?
Yeah, the master and
Yeah. Yeah, I can. I'll have to take one of the symphonies out of there though, because one of them is not. It's not public.
okay.
But yeah, I can share it.
What symphony is that?
It's called Moonshot. It's like a variant of Beta Baller. So if you wanted to put something, if you wanted to keep, yeah, it's just a variant of Beta Baller. Okay, there's the logarithmic scan. A lot of logarithmic's pretty good. That's funny.
Yeah, that's really surprising.
And that's all that is just RSI checks. There. Okay. Any other questions? Bento Rita, here's one I wrote that includes Wham, but was not badly bitten by Yin. It uses inverse volatility to weight the groups. Nice. Okay, well, I think that's going to do it for me, guys. I got to hop off so I can give my family some attention over here. For sure, man. Yep. Looking forward to the next one. All right. Thanks for joining, everybody. Appreciate it. Dun, dun, dun.